So we're going to talk distribution. Distribution is probably the number one most important thing in the ETF space. Some people will argue that it's product creation, but product creation doesn't do much if you can't sell it, right? We have a really good panel here today. These folks have been around the industry in a variety of different ways. We're not going to go through their bios. You see who they are. I'll tell you, they're very shy, so it's going to be difficult to get their opinions out of, especially the guy in the middle, Mr. Bathon. But let us dive right in. So first, Jillian Del Signore is Global Head of Investor Distribution at NASDAQ Indices. Neil Bathon in the middle is Managing Partner and Founder of Fuse Research. And Bill Arnold is Senior Vice President of Sales and Distribution at Tidal Financial. So the thing we want to concentrate on here is this. 4,400 ETFs out there, not all are going to be successful. When we look at really what's working and what's not, Neil, let's start with you. 4,400 ETFs. Not all issuers will make it. What separates those that are successful and those that aren't?
I have no idea, really. I'm not even sure why I'm here, but...
You need to speak up a little.
How about this? I think for most of the ETFs out there, it comes down to the same things it always has. It's performance fees in the category you're in terms of momentum there. And then as you started off with, it's the distribution you can wrap around that. Was that good?
That was excellent. Jillian, anything you could add to that?
ETFs are sold, not bought.
Bill?
Yeah, sure. I'll add some context as well. I think the biggest thing, and certainly as we're talking to new firms that are thinking about launching ETFs, just because you launch an ETF doesn't necessarily mean that people are going to buy it. You have to have boots on the ground. You have to be willing to go engage with the audience in buying the ETF. There have been a number of ETFs that have launched that haven't gained assets because the firms are not selling them. And another thing is the platforms or the availability of your product. Just because the package is available doesn't mean it's necessarily available on every platform. So you have to engage with those platforms. So it's just not the end user. You have to be engaged with the platform.
So Bill, accessibility, and talk about accessibility.
Yeah, sorry. I think that let's take a step back, because I think, and I don't know the sort of personas we have in the room here and who knows what about distribution. I can see a lot of faces who do know a lot. But accessibility is the key. I anchor to that word all the time. Just because your product is brought to market doesn't mean it's accessible by all the investors you want to buy it. ETFs go on what I call this journey to availability, and where it's starting off with retail investors, which are becoming more and more critical, and you're seeing products launching just directed at that market now, which is the first I've ever seen that, and registered investment advisors. And then as they gain assets and as they gain track record and any host of other things these days, I mean, whether you're willing to participate in platform fees, there's a whole host of things that you go through to become available with the independent broker-dealers and ultimately the wirehouses. And why does that matter? It matters because if you're a new issuer, you need to figure out how to staff yourself or engage partners in such a way that you can engage with RIAs, which is a fundamentally unscalable market to service. And if you're an existing asset manager and you have an existing RIA team, for example, you need to figure out how to incentivize those people to sell ETFs when they've probably been selling against them for the better part of their careers and can't wake up every morning and see a trade run. So it's nuanced as you think about trying to get this product into the hands of those who can buy it. So that's sort of how it's...
So getting on platforms can be a blessing and a curse. If you do get on, it's not just, okay, smooth sailing, because you've got staff for that. A lot of times you have to write checks, right? And you still have that same competition. Bill?
And we actually just had a firm that got their product on a platform today, just got the email this morning, and they said, congratulations, it's on the platform, but you can't come into our offices and sell it. So there's additional challenges that every firm are going to have when they are engaging with the platforms. So again, it's certainly big hurdles, but you have to spend time with these platforms.
Well, and a lot of people are prioritizing. I mean, if you think about it, if you're a new issuer, and congrats, you're on Morgan Stanley, right? I'll take your $100,000 check now,
Yeah,
right? Like,
yeah.
it fundamentally changes your strategy because as a new issuer, you can't truly afford some of these things. And so it's a blessing and a curse to get this exposure. You may not also be staffed to support a Morgan Stanley or a Merrill Lynch, and they want to know that when you become available on these platforms. So it's completely changed. You're seeing a lot more folks lean into the independent broker-dealers, which are also catching on, and creating sort of partner programs or data packs, because you're really paying for data and you're paying for access. But it changes the way some of these newer firms are even thinking about distributing because they can't afford to participate.
So we're touching on.
Wait a second.
Go ahead.
I think it's great to be, I don't question that ETF is a better wrapper than a mutual fund, but ETFs don't have a better track record at success than mutual funds do. New mutual funds launched in the last 5 years have the same success and fail rate as new active ETFs launched in the last 5 years. So the distribution isn't really that different for intermediary distribution and for mutual funds versus ETFs versus SMAs. Some platform access is not all that worthwhile. If you're not improved or if you're not recommended, if you're not in a model, I don't think you should expect a whole lot of sales going forward. I don't know, did that?
Okay, but if you're a fund company and all you have is funds, and you're experiencing flows, average flows of what the industry's receiving, should you get into the ETF business?
New relationships will be formed around ETFs. I don't think there's any questions about that. But advisors will continue to add to positions in mutual funds that have served them well.
Even though net we're seeing redemptions.
Well, there's old assets in mutual funds, and there aren't old assets in active ETFs.
Okay,
New mutual funds sell just as well as new ETFs.
really?
Yes. I may have made that up, but it sounded pretty.
I would.
Okay,
yeah.
Go ahead, Bill.
I'll add this, and probably from some of your research, by the way.
Okay, go ahead.
The delta between mutual funds and ETFs and cash flow over the last 10 years is $7 trillion. It's real. It's impacting everybody, all of our new clients. We have the conversation. It's the reason why they're coming to the ETF wrapper. Investors are telling us they want this wrapper. And accessibility is one big thing, certainly taxes, certainly cost. But again, it doesn't mean that just because you launch it, and that's, I think, what we're trying to get across here, is that investors aren't just going to come. So
Yeah.
it's about engaging with the platforms, it's about engaging with the advisors, but it's also maybe using resources that you may not have used before, like the firm that's actually helping us here, Hybrid Financial. They're a firm that actually reaches out to advisors to hit the area of the market that maybe your sales force can't. So it's maybe engaging new firms that might help you out and get your product
Yeah.
available.
So to put things in perspective, Title, white label firm, a lot of asset managers come to you, you help them get ETFs to market, but you don't help at all and promise to help at all from a distribution standpoint, correct?
Correct.
Right.
Correct.
Okay.
We are there to hold your hand through the launch of the product, to educate the team. By the way,
Yeah.
ETFs have been around for 30 plus years, but the reality is a lot of firms have no experience with ETFs. So
Okay.
there's a lot that goes into educating the teams to help them understand the product.
Okay. Assuming everybody in the room is either in the ETF business or thinking about getting into the ETF business, Neil, talk a little bit about sales structure and what works and where the flaws are today.
Again, I just don't think it's that different. I think the firms that we see being successful with ETFs haven't meaningfully changed how they do things with their mutual funds or separate accounts or interval funds. One of the big challenges is the data side of things in terms of we got pretty good at data analytics for mutual funds and guiding advisors, and it's just it's a different world in terms of ETF data. But I don't see, there's ETF specialists for the capital markets side of things, but I don't see substantive differences between distribution structures for ETFs that I did with mutual funds.
Jillian,
Yeah. So
you don't have to agree with him.
I don't know. Yeah. I think the elephant in the room, maybe it's not an elephant in the room, but I think salespeople are incented to sell, and they're selling to people that they know, right? They're getting paid by selling products that are established, have a track record, they can sell, they can move. They're not incented to prospect. And so if you think about the quandary that you find yourself in, you're bringing your product to market, whether you're a new issuer or whether you're an issuer that exists today and you're trying to incentivize generalists to sell a new product, one they may not be familiar with or comfortable with, that's where I think the likes of hybrid can come in. Because if you have an existing sales force, you can use things like data, right, to optimize their outreach. They're talking to people that they know, they're potentially cross-selling new products. And then you can leverage external resources like hybrid who will do all the prospecting for you. So I think the incentives become back to me. I think about access and I think about incentives in order to get things actually off the shelf, right? And where you can't incent someone to necessarily prospect just by the way things are structured, leveraging folks like hybrid who can bring the leads to you, and then the salespeople can actually go out and sell the product. That's the way I've been sort of thinking about this on both sides.
If you could get a salesperson to follow up on a lead, yeah, that would be great.
You've got some feelings about relationships as far as wholesalers and how many relationships you can have, and even current clients that may own your funds or own your ETFs. How often are people touching base with them?
Or touching what?
Are they calling them?
Oh, I mean, I think wholesalers could have maybe 400 relationships and properly engage with them. And so that means for any territory, there's another 20,000 that they can't get to. So did we mention hybrid yet? Yeah, I think employing something like that to cover a broader range of market would be a good thing. But
Okay, we might need another mic up here. Thank you.
we could share. Oh, this would be cool. Nice. First time ever.
Thanks. Bill, what would you say?
Just to kind of piggyback on what Jillian was talking about, the compensation structure, I think that is a big piece of this for firms that are coming to the market. Typically, with most firms and other packages, you get the data of who actually is buying your product. The biggest challenge for a lot of firms coming to market is they're not going to get the same data. They won't find out who is actually buying. And so it is very important. It's incumbent on that firm to make sure that they're compensating their individuals, figure out a new solution. By the way, I don't think that there's any right answer here. I just think that you have to find a new solution in how to compensate your salespeople. And I can give you a number of different examples where a firm launches ETF business and they decide that because they don't get the data, they're not going to compensate the sales for ETFs as they do mutual funds. Well, guess where the salespeople spend their time? They're going to spend it on the fund side. So it is definitely important to figure out a solution that makes it comparable. It doesn't mean that you have to pay more for the ETF sales. It just makes it comparable to what else they're selling. Salespeople will go where they get paid.
Yeah.
Well, that
Jillian,
was-
talk about data, because as you talk about platforms, in many cases you're having to pay up for data too, right? And how many firms out there, especially mid to large firms, do you see that are buying up all the data and it's rotting on somebody's hard drive?
Yeah, it's interesting. You can probably count on one or two hands the firms that are actually consuming the data and doing something effective with it, right? Data is worthless if not utilized. That's telling you something obviously everybody knows in this room, but I think to utilize the data to try to help enhance every engagement that your salespeople are having is the way we've seen it used most effectively. It can, you mentioned 20,000, whatever, every territory has thousands and thousands of advisors. To be able to use the data to help enhance the engagement that the salespeople are having and then help you be smarter about how you're digitally marketing to the rest. I want to hit on the compensation piece, though, because I think it's incredibly important. In a prior life, when I was building sales plans and building ETF specialist teams, and frankly doing some of it wrong and figuring out the hard way how to do it right is to, with the proponents of data that we have, it's getting a little bit easier to pay ETF salespeople on production. One thing that I saw that wasn't working where I was the misaligned incentives of generalists and specialists. You know, generalists, we were overpaying, but we were paying a lot to incent them to sell something that they were uncomfortable selling at the onset. And so paying something like 4 people on every dollar that was coming in the door, but it's a way to scale. But the ETF specialists were just being paid a base and a bonus. And so there was really a misaligned incentive and then the misaligned partnerships. And so I know it sounds like we're sort of beating a dead horse here, but it really is critically important to have these incentives aligned in order to get the product off the shelf once you have access into the hands of those who can buy it.
So the big thing is with the data, and if you're doing it right, and if you got the right people managing the data in-house, having a data scientist, making sure that you're pulling all the data in, and knowing first and foremost who owns your ETFs, making sure that you're communicating with them regularly, and then from a sales standpoint, making sure that you have a fair compensation. Bill, what would you add to that?
Yeah, it's very important if you are paying for the data, make sure that whoever is managing that is still part of the business. I was at a firm that they paid all this money for data packages, and then what they would do is sit with the data team. So nobody in the business, none of the sales managers, none of the principals that are in charge of the sales team, nobody was engaging with it, because it's very important to make sure that the strategy of the sales team actually uses that data to engage with clients and advisors. So it's important to keep the business involved in the data cleansing and data working through the data.
But beyond, most firms have pretty good data at this point. The utilization is about 50%, and if you don't change sales management's mindset and change compensation plans, the data won't work its way into having an impact on the ground. It's incredibly frustrating to see how much money firms have spent on data and how little of it actually works its way through to guiding tactically any wholesalers.
Mm-hmm. But if you get it right, and you guys have seen shops that get it right, what
If
can
you
it
work
mean?
with hybrid, I think.
Okay.
I just wanted to say them twice first.
Yeah.
Okay.
Well, I mean, hybrid's a great option, but at the same time, there's responsibility internally to make sure that you get it right from a data standpoint.
It's just so few firms that
Yeah.
do. It's
And it's not that difficult today. The data's available, and it's not that difficult being able to pull 13F info and advisor data, right? Jill, what'd you say?
I mean, in my experience, there's firms that are buying Broadridge, you're getting data from Morgan Stanley and LPL and 13F, and nothing is coming in the same file format. You really have to have a team that is there and taking this data and putting it in a usable format, getting it to get into your CRM. The way I've seen it most utilized is to help inform territory structure and focus for generalists primarily, to identify where they're going to focus. You are able to tell who are the largest consumers of ETFs. You can prioritize, send off certain clients to the specialists. But really, I mean, the data we have now, you can even look, we're starting to get intent data, right? So the goal would be to not only have it utilized to help create focus and territory structure, but to also then help you have that much of a better engagement with the advisor, know what they're going to want before you arrive, so that you can be presenting them, don't pitch them, presenting them resources that are associated with what you know they are already buying and are likely to then buy from you.
So that is key and critical, because in most cases, if we have distribution, we have a new ETF, and the mandate is we need to get it out there, and we need to get to all advisors and tell them how great this new ETF is. Bill, that's a big task, right?
It is a really large task, and there are ways to do it economically. Maybe it is hiring an ETF specialist, somebody that understands the package, because again, ETFs have been around for a long time. The reality is a lot of institutions and advisors still need the reinforcement of how to engage the product. So to have an ETF specialist rather than getting 10 new ETF salespeople, that might be a good way to do it economically so that that specialist can help out your broader sales team. Maybe it's outsourcing for capital markets to be able to help engage, have your sales team engage.
So
And
you
there
can
are ways to do it.
pull 13F info for competitive products, and that's an easy way to start. You mentioned hybrid. They also have behavioral data of others that they've engaged with, advisors that are looking for those types of strategies, right?
Absolutely. I mean, the intent data, I think, is where it can become really critical.
Yeah.
Because, again, you're launching a new product. And this is in my day-to-day at NASDAQ, one of the things that we are trying to do is help as clients are bringing product to market, help them understand the market of which their competitors currently exist, where is it being consumed, who is buying it, what types of investors, and then helping them develop strategy to make sure that their product gets into the hands of those who are going to buy it. And so the intent data becomes really important to us as we're informing them on the current market landscape, and then as they're looking to specifically market into the advisors and to retail. We certainly cannot forget about the importance and the growing importance of retail investors. It's not just sort of this monolithic wealth push, right? There is a whole, obviously institutional and otherwise, but I think retail is becoming more critically important as well.
Neil, you know the advisors for years, and it's brutal. I mean, we were just talking about lunch, how many emails you're getting from ETF issuers about all different things. I mean, what are things, if you gave hints for ETF issuers today, how do they communicate with advisors successfully?
Well, I would start with the notion that the advisor doesn't need your strategy. There's not many new ETFs, particularly on the active side, that aren't overlapping with something they already own. It really has to be around how you're going to help them build their book, and that's much more about some of the value-added programs than it is about the underlying strategy. I think you can count on advisors that you help their practice to get better, stronger, to use your products. But I think we're past a point where you can lead with product and hope to have successful access.
So you're not talking about taking them out to golf or steak dinners. How do you help?
That's First Trust. They're not a client, I don't think. Well, not now, probably. No, it's about helping them build their referral network and tactically guiding them through it. It's some of the traditional value-added programs, practice management things that asset managers got away from for a little while.
Well, it's so critical. Like I said, ETFs are sold, not bought, but you can't sell them, right? Like you have to sell them, but you also can't sell them, right? You have to be in there as a resource, right? The chief resource officer of the territory, and bringing in specialists, regardless of what some firms, like BlackRock has factor specialists and they have SMA, there's specialists all over the place. And so I think being that resource officer of your territory is becoming more and more important. Earning the right. If you're a new issuer, you don't even have the right to be pitching some of these advisors, right? Who are you? What do you stand for? What are you selling? You have to earn that right by providing resources, providing education to these advisors who are getting called on by literally hundreds of asset managers on a weekly basis. And so how do you differentiate yourself? What are you bringing? You look at some of the firms that have been successful in ETFs even just this year, they stand for one thing, right? I look at certain firms, we only do options. We only do alternatives. That's where you see success. Know who you are, what you're trying to be, find those advisors who want that thing through the data that we're talking about, and then provide the resources that maybe only you can because of your expertise to gain credibility. It's not going to happen overnight. I was having dinner with somebody last night and we were joking that what's the old adage? It's 5 or 7, whatever the number is, times you have to tell somebody something. It's also not instantaneous. I've been in organizations where you have to really manage expectation as to how quickly something's going to get off the ground. If you raise $100 million in a couple of years, I don't want to say a couple of years, that's maybe under clubbing a little bit, but it's hard. There are certain products that can shoot the lights out Not everybody's IBIT, right? Let's not forget that there are real anomalies out there, and it takes a lot of time and a lot of effort to truly scale products. You have new issuers come to market, and years later are scraping to get to $5, $6, $7, $8, $9 billion.
Do we have any advisors in the room? Advisors, okay. So when you buy an ETF, how often do you hear from the ETF issuer? Or do they even know that you own it?
Sorry, I'm not an RIA.
You're not an RA, okay, all right.
Oh.
I would just say
Go at
as,
the back.
all right. Folks, do you hear from the ETF issuers after you've bought their ETF?
Very rarely.
Okay. And we find that that is the case, that when you ask advisors, rarely do they hear from the issuer. And guess what? They can get the data, number one. Number two, if they do call, what do? They try to sell you something. That rather than saying, tell us about your year, how do you feel about the market? At year end, what are you doing to reposition your portfolio for next year? Like asking, look, we all know advisors have huge egos, right? They want to be stroked a little bit. They want to, rather than just being told that this is the next hottest ETF. And I think today we've fallen into that. Bill?
And I'll also, a lot of the firms that we're talking to are traditional asset managers, active asset managers. You have to be willing to maybe think outside the box. I was just at a bell ringing earlier this summer, and the firm actually had a bunch of influencers there. That's outside of my world. I grew up in the traditional space, and it was interesting for me to see, but they've been able to build their business via influencers.
So you're talking about social media,
Social media,
podcast hosts.
something that my kids are used to and I'm not. So it's very important to start thinking outside the box. Not everything that we always have done before will always be successful. You might have to start thinking about new and better ways to do it.
Not might.
Yeah.
You have to. When I got to NASDAQ and they told me my title was going to be Wealth and Retail, I said, retail. I know Robinhood, Betterment. I didn't know. I'm embarrassed to tell you I didn't know who. Maybe you don't either. Maybe I don't have to be so embarrassed. I didn't know what Webull was, right? Webull Financial. Maybe everybody could do a poll. Maybe I'm not the only one that didn't know what Webull was. But I grew up for 25 years with financial advisors. And, it's interesting. We have a variety of partnerships. My team, I've executed a variety of partnerships with retail platforms. And it's been incredibly powerful to see, again, years ago when we were first starting to market to retail in a previous life, we had no way to really mark an ROI on that spend. We would put an ad on CNBC and check the volume, the day the ad ran to see if we had an uptick. There was no science to it, right? And now you can partner with platforms like Webull or like Blossom, based out of Toronto, and you can get an ROI on that investment. You can see who has clicked, who's engaged, who owns it, what the assets are that you've raised, and it's really much more powerful. It doesn't feel as black boxy, right? It's not opaque an investment as it used to be. I'm meeting with my first Finfluencer in a couple of weeks. That's going to be the new experience, but to figure out ways to engage with them. If we think about the next generation, Gen Z is far more engaged with their own finances. They're trading more frequently, and they are engaging online.
Are you going to do a TikTok dance with this person?
I don't know. I don't know what I'm going to do I'm going to figure out some way to work with them, because a lot of these. It started at a conference 2 years ago, and I had an ETF issuer tell me that they were Googling their prospectus filing, and they found individuals on YouTube reading the prospectus, and they were getting tons and tons and tons of views, and so they started literally sending like baseball caps to these YouTubers, and that was the start of how they were engaging them. And it's obviously evolved tremendously since then, but it's become a whole different way to market your product. And you're seeing ETFs come to market today with, like I mentioned earlier, the explicit audience of retail, and there are now ways to reach it. And it's funny because you always say, well, the first audience is retail and RIA. And they're both really challenging to access. And RAs remain challenging to access, but you have partners like Hybrid who can help you do that. And then with retail, while still challenging, there are platforms out there that can help you truly access that market.
Neil, what would you say? Don't talk about your Instagram account.
About, I guess, I don't think that, I think if you have mutual funds you can convert to an ETF, you should do it. I don't think there's any strategies, very few strategies, if you launch them, they shouldn't be done in an ETF. Having said that, I don't think people realize that ETF doesn't fix the main problem with active management, which is the inability to beat the benchmark. And the fee differential between mutual funds is interesting, but it's not enough to make up the gap between the active performance and benchmark. So I think I just caution people to be a little bit balanced in their future view of where the growth is going to come from, because on the active side, it still is challenging as ever to prove that you can consistently outperform.
Well, the wrapper's not magic.
No, it's
Right.
not, and you've got to be different. That you've got to be different.
But you can only be so different, right? Because then at some point you break outside the boxes that the home offices want to put you in.
Well, if you look at the active managers that have been, I'm going to paint broad strokes here, but a lot of the active managers that have been successful have followings, right? They're incredibly well known with their mutual funds, and they've been able to bring their products successfully into the ETF wrapper, figure out how to successfully incentivize their people to sell them. There's sort of method to the madness of what they're doing, but yeah, I think there's plenty of those same firms have plenty of products that they've tried to bring to market that, again, the wrapper's not magic. If you have terrible performance and you have no assets, like you can't bring it into the wrapper and suddenly it's going to jump off the shelves like gangbusters.
And
So I think
social media, as you point out, is just a modern form of communicating. Just a modern form of building that relationship. And if you think about it, everybody's going after the same advisors in the same region. We are seeing some companies do exactly what you're saying, Jillian, and they're going after self-directed investors first, educating them in a whole variety of ways, and guess what? Advisors find out through their clients about those strategies, and then it ends up coming full circle. Bill, anything you'd comment on that?
I just think that it's important for firms to focus on what they do well. There's a reason that you've been able to build a business for a long period of time. You're hearing from your clients that they want ETFs. I can't tell you the number of the firms that we've helped launch products, they kept hearing from advisors, why don't you have this in an ETF wrapper? The clients want the package. So I don't necessarily think that it's a bad thing to launch the product, but make sure you re-engage with those same clients. Make sure you're reaching out to your existing client base, because they're the ones that have already been sold on the product. So be cognizant of that.
Yeah. Okay, so in summary, what's actually working? What is actually working for new ETF issuers or fund companies that are getting into the ETF space? If we were to go over 5 things, what's most important? What do people really need to take away from this? Jillian, you start.
Yeah, again, I anchor myself around, there's 4 words. Stick with me, I should probably do 3, but I'm going to do 4. Access, so start with the end in mind. Who is buying your competitors today? Who are they, right? Can you access them when your product comes to market, and have a plan for how you're going to do that? So access, understanding that access. Optimization, so if you are buying data, make sure you're optimizing the use of that data. Use that data to help inform, if you are an existing issuer, inform the sales team that you have with that data, make them smarter in every engagement, use the intent. Optimize partners like a hybrid to do the prospecting for you, because as we've talked about, no one is incented to do otherwise. Incentives, we've talked about, so incentives and aligning incentives and getting them correct. And last is resources. access, incentives, optimization, and resources. Who are you to the marketplace? Are you bringing those resources to bear? Are you being the resource officer to the advisors? Because you're going to have a very challenging time otherwise getting any airtime with people who want to buy your product.
So when you talk about resources, Bill, let me give you a scenario. If you had the choice to hire 4 wholesalers versus 2 wholesalers and 2 data people, what would you do?
I think personally I would do the second choice because it's going to be important for you to help guide your strategy for the data side, but also for how you're compensating your the folks that you currently have. I think that's going to be important.
Yeah.
I want to say there's one additional thing that I would add to Jillian's list. It's to understand the product. Again, we spend a lot of time with our firms that we're helping to bring to market. We actually spend the time and say, here's what a create redeem is. That is invaluable because a lot of folks in the industry still don't understand how the shares actually come to the marketplace. So education, I would add, that would be my, if she had 4, 5th, education. Learn the package and learn how that product comes to market because it's going to be important as your salespeople are in front of clients so that they understand how to engage with the product. It's extremely valuable.
Neil, I would say we've known each other for a long time. I know you want to say something here, but
Killing me.
I know, but your job is to analyze fund companies day in and day out, and you've been doing this for decades. So part of your conservatism in your presentation is because you see that a lot of people don't make it, right?
Yes.
And it's not as though it's not a good business. It's a great business, and I know you're a big fan of this business. But I think you're speaking from your heart. It's tough.
Yes, it is.
So, sorry, what were you going to say?
I would scrap the points that Jillian and Bill gave you altogether, just because it seemed like a cool thing to say. I think so many firms don't get pricing right, which is odd because it's available to you. You still need performance if you're going to get platform access, and I would probably skip the salespeople altogether for a period of time and rely almost entirely on PR. I think it can have a remarkable impact as you're building your track record and your reputation.
I would emphasize that, it might sound counterintuitive coming from a distribution person, but I actually don't overhire. At a former role, I was given the opportunity to hire 8 people. I probably should have hired 2, right? Especially when you're in a generalist specialist dynamic. I didn't appreciate the territorialism that would develop. And I hired salespeople. I hired people that had been selling ETFs at other organizations where that dynamic didn't exist. And it became very challenging for them to actually execute on their job. So I would really understand the dynamic of sort of where you exist today and what that current structure looks like and what the introduction of new personnel will look like and what the persona of that personnel should be. So again, it might sound counterintuitive, but sort of slow roll, especially with the resources that you have today to help augment that through third party. I don't think you have to overhire out of the gates and really think thoughtfully about that. This was 10 years ago now, but it really, it was more challenging than it needed to be for me because of the number of people that I brought into the dynamic when it could have been, I think, a more traditional specialist model versus sales specialist, which is what I brought into the organization.
Right, but it's hard. I mean, once it takes so much time and money to finally get to the gates where you get launched and you ring the bell, and you want to just explode out there. But in order to do that, you have to be organized. You have to know the horizon. You've got to have the data. You've got to have the money to put the right sales force together too. And as you mentioned, Neil, with PR, and I'm going to throw social into that because that's all a part of that. There's a lot that you can get inexpensively as far as education and knowledge. And most importantly, I know hybrids come up a few times, and these guys are sitting there right in the middle. If you're in that situation where you're trying to go through this process, and rather than putting the team together managing the team, managing the data, it's worth having a conversation with them because they can act as your distribution. And you can try them out and you know pretty quickly if you're doing well or not, right?
Well, and I think also, I mean, I said optimized partners and I mentioned hybrid, but there are other partners, right? So I think, who's your exchange? Who's your index, if it's an index provider, who's your index provider? What are they doing to support you in market? They should have a plan alongside you because their incentives are aligned. Your incentives are aligned, and if they're not, then different conversation. But their incentives are aligned, especially for an index provider, and they should be working with you to try to help consult on what is going to be the best path forward. Whether you're the biggest asset manager out there or the smallest, it doesn't matter. So I would say really think critically about who your partners are and how they're going to support you when you are in market.
And leverage those partners. I can't tell you a number of firms that I've talked to who launch with, whether it's NASDAQ or New York Stock Exchange, and then they don't engage with them. They're a marketing arm for you. Use that, use that to your advantage for sure.
The cool thing about the ETF industry is it's a fraternal group. People share. In this room, you can look around and you have friends that maybe you worked with, or they're in another firm, or maybe they're a client. Ask. I'll tell you, one of the tools I look at all the time is the ETF league table. And you've all probably seen them. ETF Action has it updated every day. Look on page 4 and look at the companies that are moving up and ask yourself why. What are they doing that's different? Is it the product? Is it their sales? Is it their data? Are they getting great PR or additional support? But look, we're not shy. We'll copycat all day long if it's going to mean something. But most importantly, we hope today was honest, but encouraging at the same time. We've got a few minutes for questions. Yeah, Devin.
Yeah, so, Jillian, talking about the specialist versus generalist, are you optimistic on the future of...
We're going to have you repeat that, Devin. Okay?
Jillian was mentioning generalists versus specialists and the compensation. What do you think the future of a specialist is, right? And my question is coming from, if you're a generalist, right? Let's say you're a wholesaler, and you're able to take your fact sheets, your prospectus, your market commentary, all the home office research reports, your meeting notes, right? The advisor in your territory, and you're able to have them all in a digestible format like JSONs, et cetera, right? With that, then you're able to easily retrieve any type of knowledge that relates to not only your product, but the advisor you're selling to, right? So thinking about like fast forwarding 1 year, 3 years, 5 years of where technology is going, I mean, I could easily make an argument that generalists will then become specialists because of the power of information at their fingertips.
I don't disagree. I can't see you, but I don't disagree. Luckily, I know who it was that was saying that. I don't disagree, Devin. I think you look at certain firms that had specialists. The one I came from, right, they no longer have specialists for a variety of reasons. One could be the types of products that they're launching that look very similar to the mutual funds that they have, and so that's an easier story for a generalist to tell. 2, time in market, right? But then you have other firms, I use Invesco as an example, right? They continue to have specialists because of the vast volume of products that they have and the need to really target ETF-specific investors, which I think are getting fewer and far between also, frankly. But yeah, I think that it depends on the organization. It's so challenging to paint a broad stroke. I think they're going to be necessary, especially as new firms are getting off the ground. Some of these newer issuers coming to market certainly do need specialists, even just to have the DNA in the organization and encourage that as they get incentives aligned. But I think you're already starting to see it, Devin. You're starting to see firms that did have specialists start to back off of that as the generalists are getting more and more comfortable with that story.
Would you say a specialist, if they're on the phone with the advisor's already interested, but the specialist can help with portfolio construction?
Absolutely, and the nuances, I mean, a lot of firms have their own capital markets teams as well, but the specialists do take on that role a lot of times. And so it's there to talk about the nuances of the vehicle, the same way you see like an SMA specialist at certain firms and alts specialists, right? It's the nuances of the dynamic of the vehicle or the exposure. But the generalists are getting pretty proficient, right, in ETFs as they become more and more mainstream for advisors.
Great question. Thanks, Devin. Another question? Yeah, right in the middle here.
Thank you. Question is probably more appropriate for Jillian or Bill. Something
that's
also
fine. Don't take it personally, Neil.
No,
Don't. It's okay.
Well, you'll feel free to answer it. Rev share, and that's something that's new to ETFs. I would say in the last couple of years. Can you share some insight on that?
It's home offices trying to bridge the gap, right, of the huge revenue loss, right, to state the obvious. As more and more of their books have shifted from a structure that explicitly pays them to one that does not, they're trying to figure out a way to bridge that gap, especially as more and more active mutual funds transition into active ETFs. So, you know, I'm not here to tell you that I never thought I'd see the day, right? I've been in this industry a long time, but it's here and it's here to stay. I think certain firms are giving more for that than others. Certain custodians are just charging for the price. It's just the pleasure of doing business with us, right? The pleasure of the access to my advisors is you're going to pay a certain basis point off your expense ratio. Others are truly providing value, right? They're providing you data. What you do with that data is up to you. But yeah, I believe it's here to stay because that revenue gap is not changing. Go ahead.
What percentage of new ETFs are? What percentage of these new ETFs, and most likely these are small boutique issuers coming in, working a rev share deal with a broker dealer who's going to give X amount of millions of dollars to fund that ETF? What percentage of new ETFs are involved in that?
I think, are you talking about seed? Well, you just said to seed an ETF.
Seed with
Oh.
rev share. They're getting paid off of that seed.
I don't know that I'm following the question.
Yeah.
So the rev share is happening between the home office. But the home office isn't seeding the product.
Of an agreement with a whether it's a broker dealer or a large RIA coming in, putting assets into an ETF,
Sure.
and then getting basis points off of those assets.
So much for being an RIA, right?
Yeah.
Your fiduciary responsibility.
No.
Yeah,
so,
I don't.
Why don't you just explain where most of the seed comes from, if there is seed?
Right. If you can get seed from an RIA or an institution, pathway to success, right? Because you've got real assets in the product. It doesn't necessarily always help at the home office level because they want to see a diverse set of shareholders, from my experience. But yeah, the rev share is happening between the home office for access to the advisors. I think some of the custodians just recently announced that they're just putting rev share on ETFs again, just for the pleasure of doing
and
business
really
with them.
hasn't been tied to seed.
No, not
Yeah.
tied to seed at all. And it had been tied to active ETFs, but I feel like that's even gone away, and it's now, generally speaking,
Yeah,
sort of
tend to be
ETFs more broadly.
Independent. Yeah.
And offering, some are offering data packs, others are offering, partner programs, things that you're gaining as a part of that payment. But there's nothing consistent necessarily about it. The consistency is they're charging. The result of what you're getting for that is not necessarily consistent.
Yeah. Neil, do you think we'll see more platforms doing rev share?
Oh, absolutely. I don't think there's anything that's going to stop distributors from insisting on taking a portion of your fee.
Yeah.
Absolutely, yes.
Okay. Thank you. Another question over here?
You mentioned kind of seed capital. What do you think's like a good number? Say you were going to launch an ETF. How much,
More.
how much capital? Clearly, higher is better. So, what's kind of like
That's a good Bill question.
Yeah, totally depends. Depends on the strategy. Fixed income might have to have more seed in a product than just a generic equity product. So it really depends on the product. Obviously, more is better if you can. But more importantly, firms have to start thinking about the partners that are going to be helping you bring that product to market, like lead market makers. They want to make sure that you're committed to the product. So having, whether it's clients lined up or maybe the firm has seed that they're going to add to it, I think it's important that from the firm perspective, that they are actively thinking about, all right, how are we going to make sure that this becomes successful? Those partners are not, they don't make money off of lead market making, all right? So those partners want to see that you're committed to the product.
And I know there's some in the room, or there are some here. They're getting asked for. Think about the number of products that come out every day, right?
There's 4,000 products.
Yeah, 4,400 products in market, 500 and something this year, more than that even. 50 plus new issuers. So there's a lot of asks going around. So just to echo his point around having a really thought out distribution plan to take that seed off.
And just to put it, Jillian, in perspective, if you get $1 million in seed, there's a lot of pressure to get to 10, right?
It's infinitely harder to get from 1 to 10 than it is from 10 to 50 and 50 to 100.
Yeah.
It's incredibly, if you come in with that little seed, it's going to be a Herculean effort to get that thing off
Yeah.
the ground.
So you either try to have it lined up ahead of time or do all you can to get a higher seed number. And it's just, I think a lot of people in the room know it's just worth it to get as much seed as you can. But it's a great question. Any other questions? All right, great. Folks, thank you. This was great. Excellent. Thank you very much.
Thanks, everybody.